Hello, everyone. Welcome back to Navellier Market Buzz, episode 23. I'm Crystal Navellier, and I'm joined again this week with my father, Louis Navellier, and also Jason Bodner, who's a co-founder of Map Signals. Welcome back, everyone. If you didn't get a chance to watch our latest episode, it's earnings season, and each week Louis and Jason will be discussing a new round of stocks for their earning announcement season. But before we get into that, we do have some breaking news that we have to talk about. Can you guys explain what DeepSeek is, and why did it create an earthquake in the stock market?
Well, that's the number one selling app on the Apple Store. People are comparing it to ChatGPT, and they think it's pretty darn good. So they're using NVIDIA's older chips, and somehow Wall Street came to a conclusion that I guess we don't need new chips, or we don't need a new electric grid, and we don't need to make any further progress because the Chinese have perfected AI. The timing of it was very suspicious because it was announced on Sunday during the football playoffs. Trust me, every single trader on Wall Street was watching those football games, and they were not paying attention to the market aftermarket. And it went down quite a bit on Sunday, so it gapped down Monday. I think it's a gross overreaction. It was a great buying opportunity. Your mom loaded up on more NVIDIA on Monday and when it sold off. But the companies building out the data centers actually got hit even more. And some like Eaton have already announced. So I think those are probably the best buys right now, to be honest with you. But I think it just, to me, it bore a market manipulation. It was a shot across the bow from the Chinese Communist Party to kind of take some mojo away from President Trump after his SoftBank announcement that we're going to spend up to half a billion or $500 billion on AI infrastructure and all. So I was it's the volatility was mind-boggling, but thank God earnings season is here to ride all those stocks and drive them higher.
So I'm in complete agreement with you. There were some very suspicious things there. Um, First of all, not really on a conspiratorial note, but let's think this through for a moment. Like you said, Trump announced 500 billion for Stargate. You had weeks earlier, Jensen Huang, the CEO of NVIDIA, come out and throw cold water on quantum computing stocks. Let's not forget one of the forerunners in the race of quantum computing is Baidu, the Chinese big tech company. And then Trump, during his campaign trail, was threatening all sorts of tariffs against China. So, like Louis said, like you said, I think it was a great opportunity to hit him where it hurts in the most crowded trade. And let's not forget, DeepSeek's founder, Len Wangfeng, and I may be saying that wrong, was a hedge fund guy. And when he was 30 in 2015, he founded High Flyer Hedge Fund, a quantitative hedge fund, made a bunch of money, grew it to $8 billion under management. And you're legally not allowed to short stocks in China, but you know where you can short stocks is in the United States of America. So if it were me and I were the state of China and I police every single word that comes out of that country, I would coordinate a direct hit attack on the most crowded trade. I'd find a way to profit from it. I'd short all these stocks. I'd cover lower. But I'm with you, Louis. I don't think this one announcement is going to seismically shift the entire AI landscape. But even if it does, let's just say it does, what that really does is open up the field of competition for small and mid-cap stocks to finally get into this AI race and maybe wrestle some of the control from the largest. But still, the chip manufacturers, we need more chips. And NVIDIA was a super strong grower way before AI was even a whisper, putting out the best GPUs out there. So I'm in the same camp as you. It was a shock to the market, but I think we'll be back on track. And we already had a huge bounce since.
I have to say I'm shocked to hear you say that the DeepSeek founder is a better trader than Paul Pelosi.
Well, that's only temporary.
Okay.
So now let's talk about Tesla. Why did Tesla rise after missing analyst consensus estimates by 4.8%?
Because their guidance was ridiculous. I mean, to Tesla's credit, I mean they're struggling with cars now. They're having sales issues. They got to discount the cars. They're $25,000 car never showed up. Hopefully it'll eventually show up. They'll have to put the cheaper LFP batteries on them before the tariffs hit them. But the one thing that they are doing right is the energy storage. The largest energy storage in America is in Moss Landing, Monterey area. It was on fire. And somehow when they built out Moss Landing and Morro Bay, they forgot to use LFP batteries. And they were using iron phosphate batteries, which can catch on fire. So hopefully Tesla will get the contract to replace that entire battery facility, which has now got the wrong batteries. And energy storage is very popular with all the solar systems and all. But everybody wants the robo taxi. Even me. I when they did their production at Universal Studios, the show The Future, the robo van or bus, the robo taxi. From a video production point of view, it was magnificent. From a technology point of view, it was where we questioned it. But now Elon Musk said that the robo taxi is coming. It will start in Austin, Texas in the summer, and eventually we'll just have pods driving us around with no steering wheel, no driver. And that's the future, and everybody wants to see that.
Yeah, and I think all of the above is true. And let's not forget, Elon's part of the government now. So there's a bit of unspoken golden boy effect for a company now. So, and it'll be interesting, right? Because I know a lot of the public servants have to sell their interest in companies. So for instance, my former boss, Howard Lutnick, when I was working at Kenner Fitzgerald, upon confirmation of his seat, he said he would sell everything. Now, what's really fascinating about this is the government mandates when you go into public service that you have to divest all your public interest, I guess, except for Nancy Pelosi. But what happens is you get to sell it tax-free. So back when the world was ending in the great financial crisis and Secretary of Treasury Henry Paulson came into his seat, he was required to sell his Goldman Sachs stock. And I think it was 800 million at the time. I can't recall the exact figure, but there was a tax bill of zero. So a lot of these public servants will be forced to divest their holdings. I think because Doge is maybe not a official government position. I'm not exactly sure how that's going to work, but let's not forget he has the full faith and backing of the executive branch at the highest level right now.
So now when the Bank of Canada and the European Central Bank cut rates last week, why did the Fed stop cutting key interest rates?
Well, that's a great question. And I think the main reason is the Fed just wants to see what in the hell is going to happen with the tariffs. And I guess we'll find out soon because it looks like they're going to start on Canada and Mexico first. And those are our allies. So if we're slapping tariffs on our allies, what are we going to do to China? So there's all this economic uncertainty caused by the tariffs. And I think the Fed just wants to wait and see.
Yeah, I agree, but I still think rates are coming down. I cite that chart we talked about last week where we have a strong history since 2007 of the market's expectations of where rates go versus the actual Fed funds rate has a nearly perfect record of getting it wrong. And the dot plot is still indicating that even the Fed governors themselves are expecting key rates to fall over the course of the next year or two. So the pace and the rate of hikes might be in question. Cuts might be in question, but the cuts themselves, I think you may want to try and filter through the noise. And the expectation is rates will come down, CPI, inflation, and Fed funds still has a significant gap that typically closes historically. So I fully expect rates to fall. But, they're cautious, they're wait and see, but it's clear which direction things are going for me.
The most important thing the Fed did is they removed their inflation target from the FOMC statement. So Right now, we just had the personal consumption expenditures index updated. That's the Fed's favorite indicator. It was up 0.2 in December. It's up 2.6 trailing 12 months. The core rate, and actually, the core rate's up 2.8. The overall rate's up 2.6 trailing 12 months. But the Fed no longer has a 2% inflation target. They removed it. So I found that very interesting. But I do agree with Jason. I do think because Europe's slashing rates, they got another 3 to 4 rate cuts in Europe because they're in a severe recession. I expect that as global rates come down, it'll push our treasury yields lower, and the Fed, of course, will catch up with market rates and cut. The other thing that was happening last week, Volkswagen has to pay like a $1.7 billion a euro fine for emission standards. And so they are now exploring opening a third and fourth plant in America. They have one in Chattanooga. The Scout Motors plant is being built in South Carolina. Scott Keel runs the Scout. And then, but they're looking at an Audi plant and a Porsche plant. So, electricity is so expensive in Germany right now that they're really in trouble and they're losing their manufacturing base. And that's why that German election is so important. So if they don't elect somebody that's going to turn back on the nuclear plants and get them some cheap electricity, Germany is doomed, to be honest with you. I hate to be um, sad about it. And the other thing that's going on is they put all these windmills in and the wind isn't blowing, So they're all stressed out by this. So it's the German election will set the tone. But the fact that and Trump already mentioned, like, bring your plants to America. I'll give your workers the work visas and all that stuff. It's going to be very interesting to see what happens. So this is why the Fed just wants to sit and watch because there's a lot of moving parts.
Now let's switch over to discuss some of the upcoming earning announcements. Let's start out with Tyson Foods.
Well, Tyson, of course, is the big chicken stock. Okay. And there is a bird flu. Okay. So that's probably going to overshadow their earnings, but their sales are supposed to be up 1.1%. Earnings are supposed to be up 27.2%. As you probably know, chicken prices are up. Analysts have revised their estimates slightly higher. Stock has a good earnings surprise history. But with all that said, the guidance is going to be everything. And so they're going to have to guide how the bird flu is affecting their future.
Yeah, this one I know it was a huge high flyer growth stock for you. Previously, Louis, they have Jimmy Dean, Hillshire Farm, I think Ballpark, the hot dogs. The growth has come out of the company, right? It's just become kind of this cash generating machine. But if there's either an adjustment up or down, either way, the stock is going to be extremely volatile. So like you said about the bird flu, couple that with no growth over the past 1 year for earnings. They're just eking out a 2% profit margin. They're pretty levered in debt, about 57%. And, the growth for next year, they're only estimating sales growth 1.4%, but estimating earnings growth 16% for the whole year. It's got to be about margins. So if anything's disrupting the supply, it will be reflected in the share price.
There's also political risk with Tyson because a lot of the workers in their plants are not legal, but they're trying to make them legal. And I cannot imagine President Trump would raid their factories and deport those workers.
Well, he likes chicken McNuggets too much.
That's true. And also food prices would go up and that would make him very popular. So, and also we want everybody to work. So, so right now they're not raiding factories, they're raiding apartments and things like that. And so there is political risk with Tyson.
Now, the norovirus is kind of running rampant in New York City. I'm very curious what you think about Clorox.
Well, as you know, that is one of your mother's favorite products. Okay. And I can't believe she doesn't own the stock. This company is based in Oakland, California. Their sales are forecasted to be down 18.3%. The earnings are forecasted to be down 35.2%. This is an example of a stock that's getting hit by a strong US dollar. And so I guess we're going to have to get a lot of more diseases and another COVID vaccine or another COVID disease or something to get its sales up. But right now, it is not a good stock to buy.
Yeah, I agree with you, Louis. This one scores right in the middle of my system, 53.4, middle of the road technical score because it's been choppy sideways action. I mean, there's been recent strength since September, but fundamentally it's middle of the road and, no sales growth. They had one great 1 year earnings growth, but 3 year sales and earnings growth is negative for this stock. They eke out a profit margin of 4%, and they do that on tremendous volume, obviously, in global distribution, but they have a tremendous debt to equity ratio. They borrow a lot of money. Sales are estimated to grow 2.4% next year. They're estimated to grow earnings 5.9% next year, but that would still put them in negative growth mode. And me personally, I like growth stocks. So unless they come out and shock the world like they did in COVID, when everybody's scrambling to buy bleach, I don't see major tailwinds for this stock.
So do you expect a similar situation for Eli Lilly?
Lilly is one of our largest holdings. I think it's going to be spectacular. Their sales are supposed to be at 43.5%. Their earnings are supposed to be up 107.6%. I will admit the analysts have trimmed their estimates slightly because there's a perception that GLP-1 drug sales are slowing down, but they dominate GLP-1's drug sales. And so I'm expecting great things from them. They did miss in the previous quarter, but their absolute sales and earnings growth are stunning.
Yeah, Eli Lilly is a great scoring stock in my system, 67.2. So that's just below the buy range of 70 to 85, but not by much. Really strong technicals and very convincing fundamentals, which is what I like the best about it. This stock has retreated significantly since its September highs, but for the year it's up 6.4%. But if you look at a 6-month or 1 year chart, it's off from its high of 950. It hit a low of just call it 725. So all that is to say, with sort of mediocre 1 year sales growth, which was actually, it was strong, 20%, not mediocre, but 1 year earnings growth was down 16%. This company has negative free cash flow, less CapEx, and they're heavily levered. So this is a scenario where if they come out and they disappoint, the stock's already traded down from its highs. But if they come out and they beat, I would expect some serious upward pressure on the stock because negativity is already priced in. And that might be that, sort of GLP-1 slowdown that you cited, Louis. But this stock is sort of one of those, it's a little bit beaten down. If they surprise, I expect a big bounce.
Do you think Pfizer will have a similar situation?
No. Pfizer was too dependent upon the government, to be candid with you. And they're still recovering from that, but their sales are still nonetheless going to be up 21.2. Earnings supposed to be up 306.3, but they were dependent upon the government for their business. They have surprised, but we'll see. This is one of the reasons there's going to be pressure on drug prices.
Yeah, fascinating point. Little known fact, Louis, I worked at Pfizer when they were rolling out the blockbuster drug Viagra, which has obvious benefits back then. But it was a great example of creating a massive product with massive demand in the pipeline, as opposed to one forced by the government and angling for that contract. And like you said, vaccinations are down substantially. They're facing some sort of criticism right now. 1 year sales growth down 42%, 1 year earnings growth down 93%. And this is coming off that ramp down from those vaccine sales. So, they have a ton of free cash flow, a 4% profit margin. they're not really slated to grow sales or earnings next year. So I don't see major tailwinds for this stock either. I'd love to see some big blockbuster in the pipeline that is not reliant on a federal mandate.
They also got immunity from making the vaccines. So there's a lot of criticism that if you died of COVID complications from the vaccine, you can't sue Pfizer.
Yeah.
So it has a bad taste in a lot of people's mouth. But it is what it is, and but they are making some money, and I think the government will be under pressure to cut drug prices because they're making so much.
Well, I think this is also a great example of how the market has its final say in the share price. Back from 2022 highs of $52, the stock's trading around 26, 27. So for my system, it's ranking below mid with a 43. So I usually pass on those.
So I'm starting to understand why Pepsi is the second largest beverage provider. What are your expectations for them?
Well, this is a tough consumer business. Their sales are supposed to be up only 0.14%. That's nothing. Okay. Their earnings are supposed to be up 9.2. The analysts trimmed the estimates slightly. They do surprise, but this is a multinational. The multinationals are finding a lot of currency risk. And I believe Pepsi owns some restaurant chains and things like that as well. So, as well as a lot of snack foods. So, they've hit saturation, but right now the strong dollar is holding them back.
Yeah, I think that's a great word, saturation. This scores a 39.7, so really below average scores for me. They also own Lay's, Doritos, Cheetos, all those things, Gatorade. They have a great suite of brands, but none of them are growing. So they're selling into a market that's also becoming more health conscious. So now you have potentially RFK coming in and making America healthy again. And a lot of these manufacturers are using dyes, additives, heavy corn syrup, things that aren't particularly good for you. And that's sort of the sweet spot of these manufacturers. So it wouldn't surprise me to see them pivot and go healthy to a certain degree and roll out another product suite, but that's going to take a little while. So for these earnings, I'm not expecting much. 1 year estimated earnings growth of 4.6%, 1 year estimated sales growth of 2%. It's not really moving the needle. They are profitable, but they're just not growing. So saturation, I think, was a perfect word.
I'm sure Doritos will have a good Super Bowl commercial, but I'm always amazed how big the Doritos section is in the supermarket. I mean, it's huge. I mean, I can't imagine they're going to make another kind of Dorito.
They're going to try and make a healthy one. Mark my words.
They should put RFK on the cover with
exactly.
Yeah.
So I do think that we should have some positive expectations for Cummins Incorporation, right?
Cummins is a very interesting company. This is they make huge diesel engines that the trucks use. Caterpillar, Deere, they all run on these big diesel engines. But believe it or not, their sales are going to be down 5.3, and their earnings are only supposed to be up 13%. Estimates are okay with this stock. They do have a good surprise history. I'm going to be more curious about their guidance. This is an example of a company that can be hurt by the strong dollar because, again, they make huge diesel engines that go into everything, generators, all kinds of stuff. So I want to see what their dollar comments are.
Yeah, interesting point. This one scores about a 64 for me. My sweet spot is 70 to 85. So again, just outside. Got good 1 year sales growth, bad 1 year earnings growth, good 3 year sales growth, bad 3 year earnings growth, and their profit margin is 2%. I like really profitable companies and ones that are expanding their margins as they're growing. This one has a healthy amount of debt at 81%. 1 year's earnings is estimated to grow 7.9% and 1-year sales 2.2%. Those aren't huge figures, so there isn't a huge growth multiple priced in. But you look at the price chart of this stock, and it is up monstrous. I mean, over the past 5 years, it's up 100%, but we've seen a significant portion of that growth just this year from a low, 1 year ago of like 237. It's now trading off of highs at 360. So I think this is an example where there's a lot of, optimism built into the share price. So if they even fall short a little bit, I would expect downward pressure on the stock.
So we do support Alphabet Incorporation by posting on YouTube, but what does that mean for their stock?
The issue with Google is not sales and earnings growth. Their sales are going to be up 12%. Their earnings are going to be up 29.8. They tend to have a good surprise history, even though they don't guide higher. The thing that's overhanging Google is the government's antitrust decision on them to split the company up. And so when the Department of Justice prevailed and won against Google, this is the equivalent of the dog catching the car. Like, what does the dog do now? Okay, obviously, dogs are going to go for a wild ride, and I think trying to split up Google is futile. So now, and of course, now we have President Trump. So we'll see what happens to them. But right now, they do make the best search engine, and obviously, they have YouTube, which we use, and they have a lot of very important channels. So it's a good stock. I don't own it, but it's a very reliable part of the Magnificent Seven.
Yeah, I don't bet against Google. I think anybody who has in the past has been severely injured. The stock ranks at 79.3, right in my sweet spot, buy zone. That said, the company's $2.3 trillion. Like, how much bigger is it going to get? It would actually be interesting if it were broken up, because then I would feel like there's opportunity to grow the individual parts. But phenomenal 1 in 3 year sales growth, a profit margin of 24%. They have nearly $70 billion of free cash flow sitting around, very low debt. And, year to date, the stock's up 6.1%. 5 years, 176%. It just defies gravity, keeps getting bigger, and they're slated to grow sales and earnings next year at about 12% each. There's very little to dislike about that stock. And if there is a breakup, I think this is one of those cases where the individual components could be worth substantially more if they operate. So it'll be really interesting to see, a strong history of upside on this stock. I expect good things.
Advanced Micro Devices isn't doing too hot right now. What do you expect for their earnings?
You mentioned that. A lot of people don't understand why AMD is suffering, but it's supposed to be a little better this next quarter. Their sales are supposed to be up 22%. Earnings are supposed to be up 41.1. Analysts are kind of quiet on the stock, but they're behind. Everybody's making these custom chips in Taiwan, like Apple and now Microsoft for their new Surface Books, but AMD is fighting back, and the sales earnings is going to be good, but they have to provide good guidance. But we had good news on the semiconductor equipment manufacturers, so it could help lift this stock, but this one is not hitting on all cylinders, so it's not in my portfolios.
This is one I hold in a publishing portfolio, and I admittedly bought it when it was doing better. But I do agree with you. There's a lot of optimism built in the stock, and where the share price is depressed here, if we get any positive statements of a resumption of prior growth, this stock could explode. And that's not just me talking my position, because we have 1 year sales and earnings growth was down, and that's really what took this stock out at the knees. And you can see it in the share price. It's just been trending down from above 200 to say 120. However, that said, It is profitable. They have a ton of free cash flow, and they're estimated to grow earnings next year 49% and estimated to grow sales 25%. If those things hit, or if they post guidance that even suggests they'll meet or exceed that, I would expect big upward pressure on the stock because it's so beaten down right now. They are one of the biggest producers of chips. They're not going anywhere. They're not going out of business. And now there's this, recent headwind with the DeepSeek thing moving against them. So I'd be fascinated to see some positive comments because I think it could be significant boost to the share price.
So the other day when I was going on the subway and taking different stops, I noticed that there was almost always a Chipotle that was right outside of my subway stop. And I actually looked that New York City is the city that has the most amount of Chipotles. And as an avid consumer, I'm very curious what you expect for their earning announcement.
Sales are supposed to be up 13.3. Earnings are supposed to be up 18.9. Analyst committee is quiet. Good earnings surprise history. I mean, a lot of places in America don't have good Mexican food. Obviously, if you live in, California, Arizona, Texas, etc., you get good Mexican food. But this is how people get Mexican food outside those key states, and they've got very loyal consumers.
They've been around forever. Their sales and earnings growth have been phenomenal. They got a new CEO, right? Trying to turn things around. With that said, 1 year sales growth of 14%, 1 year earnings growth 38%, phenomenal 3 year sales and earnings growth at 12% profit margin. And they're slated to grow earnings 18.4% next year and 13.4% next year for sales. So it'll be interesting how this, turnaround or redirection is going. And I think a lot of those comments are going to be crucial. But I expect strong numbers either way. Whether or not they meet or beat or disappoint is another matter, but I'm really interested to see how these new initiatives are going for Chipotle.
So I think more people are starting to switch over to solar rooftops, but what does that mean for Enphase Energy?
This was a big winner for me, and then it lost its mojo, and now it's starting to come back. Sales are supposed to be up 24.8. Earnings are supposed to be up 39.6. The analysts have been quiet on their estimates, but it has missed the past 3 quarters. So when it went to more of a commercial solar with the utilities and all, Enphase was trying to help out, but it didn't work out. If you have an Enphase system on your home, and they're very popular in California, you can set it so it looks like you're not there when you're there. And that would allow you to live in California and not pay your income taxes if you don't mind lying. It was one of my big winners. I've been at it for a few years. But they do make the best software for your Powerwall to talk to your solar. And again, if you do have a California home and don't want to pay taxes, you can set it so it looks like you're not there. So I personally find that hilarious, but there are a lot of people that live in California that say that tell the taxman they live somewhere else.
Enphase, like you said, big winner, and then lost its mojo. Like you said, it scores a 39.7, so that's below average for me, but it's mainly in the technical world, meaning this stock has been beaten up because it was such a growth high flyer and there was so much optimism built into the stock. When they started to disappoint, they really took this stock down from highs. In 2022, this stock was a $300 stock, even more. I think it hit a high of 320. We're now trading at around $62. Why that's interesting to me is because the fundamentals are still really solid. They did have negative 1 year sales growth of -2%, but positive 1 year earnings growth 10%, positive 3 year sales and earnings growth of 48 and 61% each. But this stock is all about the forward, all about their comments, even with a 19% profit margin, which is huge. They do have a lot of debt because they have a lot of equipment to manufacture, et cetera. But with 1 year estimated earnings growth at 59% and 1 year estimated sales growth at 23%, those are some serious metrics. So if there's any wiggle room of surprise in there with such a beaten down share price, I mean, this thing could gap up to 75 easily, or even higher. And if they disappoint, we're sort of already down at the bottom of the barrel. So it'll be interesting to see.
Now, Walt Disney is kind of a powerhouse, but what do you expect for their earnings?
Well, they were good last quarter. Their sales are supposed to be up 4.2. Earnings supposed to be up 17.4. Looks like, and they also have revised estimates higher. So it looks like streaming's starting to work. But you're just one hit away from your latest movie too. So I suspect they're going to surprise. It doesn't hit all my criteria, but they are improving.
Yeah, Disney is a sort of right outside that buy zone for me. 69, strong technicals, but really strong fundamentals. I love the 1 and 3 year sales and earnings growth. They do make a profit margin of 5%. I'd like to see that margin expand over time. They have tons of free cash flow, which means more acquisitions of brands and franchises and things like that. They're still monetizing the Star Wars acquisition from a couple of years ago. But we've seen a slowdown in the rollout of content. At least I have. But then again, I don't have kids who are watching that stuff right now. Estimated to grow earnings 13.5%, estimated to grow sales 5.5% each for next year. So yeah, the forward-looking statements are critical. But again, this is a stock that's gapped up after a really disappointing summer. The shares traded down as low as, call it 85, I think. So we're back up around 115. So if we get any positive comments and they can clear that high of 121, which was earlier in the year in March, it's blue skies from there. So I'd be really interested to see positive comments about growth metrics that exceed their expectations. This thing could trade significantly higher.
Now let's switch over to Qualcomm and Corporation. What do you expect for them?
They're not a bad company. They're not in my portfolios, but their sales are supposed to be up 9.9. Earnings supposed to be up 7.8. The analysts have revised higher. Good earnings surprise history. So I expect them to beat, but like most techs, they're going to have to guide higher.
Yeah, Qualcomm's one I've owned for a long time. I'm up, call it 1.5%, one and a half times, 150%. I'd like to see that better performance for the amount of time that I've owned the stock. That said, right now it's scoring 62, above mid, sort of right across the board, technicals and fundamentals. Sales and earnings growth is good, but sales growth is in the single-digit percent. So it's hard to grow your earnings if you're not growing your sales substantially, unless you're cutting your cost or increasing your margin. That said, they make a very nice profit margin of 26%, and they're slated to grow sales and earnings next year in the single-digit percent. Now, the company has been sort of trading in this sideways range since July of last year. So I'm looking for anything to break the share price up or down. I think we're probably going to see a beat and a guide higher, which could push the share price up towards 190 and on a path towards breaking new highs. That said, if they disappoint, this thing is headed for lows. So it's a really binary situation. I'm interested to see what happens here.
Dad, you're a car guy. What do you think about Ford Motors?
Probably going to be the winner of these tariffs because they have more U.S. plants than anybody else. GM has pretty much outsourced its manufacturing. But their sales are supposed to be down 0.9%. Earnings are supposed to be up 11.7. Obviously, they dominate trucks. And a lot of their trucks are expensive, like the Ford Raptor, the Bronco Raptor. Minor analyst cuts here. I think the main thing is they have to guide higher. They have been losing money on electric. The Mach-E is a big seller. In fact, the Mach-E has outsold the normal Mustang. And so we want some better guidance on the EV front and overall guidance. But yeah, they still dominate trucks, so they should be fine. But if these 25% tariffs stick, oh my God, it's going to be a windfall for Ford, because everybody in Canada and Mexico is going to have to move back across the border. Ford's already here, so this really helps Ford. And GM, by the way, beat, and then they went down. This is going to be very, very interesting.
Yeah, Ford's another one of those saturated companies, like you said. They had that nice bump from the that electric Mustang and all that stuff. The F-150 is still, I think, without question, their best product. It's tried and true for the pickup drivers. That's sort of the gold standard. The company ranks a 36 out of 100 in my system. So, I'm not particularly interested in it. And that's because I love big growing companies with expanding sales, earnings, margins. And that just has a great forward view for continued strength. Ford, on the other hand, it's a very old company. It's cash cow. It's eking out a 2% profit margin. Sales and earnings growth aren't like phenomenal. They're positive. It's not great though. 3-year earnings growth is down 111%. The estimates for next year are really what's interesting to me, because they're estimated to grow earnings next year negative 8.7%. So shrinkage, and they're estimated to shrink sales negative 1.3%. Now, that said, this stock is trading down near lows for the year, just above $10. So, like Louis, like you said, if they guide higher, we're going to see some nice upward revision in the stock going back towards highs of $14 that we saw in July. But, it's a sideways chart, sideways growth, and it just ekes it all out. And a lot of people own it for the dividend. It's got a nice forward yield. But other than that, it's not really attractive to me.
Now, what are your thoughts on ConocoPhillips?
I don't own ConocoPhillips anymore. I used to own it. But Exxon surprised here recently after guiding lower. But Conoco sales are supposed to be down 7.1%. Their earnings are supposed to be down 23.7%. The analysts have actually revised their estimates slightly higher. This company also makes a lot of money in refining, although according to Exxon, that was under pressure. The way refining works, the bigger the difference between what we call the crack spreads, light oil and heavy oil, the more the refiners tend to make. But the spreads have been a little tighter lately. So this company has a history of beating. I expect them to beat, but like anything, guidance is key. And the real energy boom under Trump is not so much crude oil, it's natural gas. So maybe that they can elaborate on that and give some positive guidance.
Yeah, I think it's a great point about the crude oil. Conoco scores 48, right in the middle, has very strong fundamentals, weak technicals, and a lot of those weak technicals, like you just said, has to do with crude oil. Looking at a 1-year chart of oil, we've been very range bound. And right now, oil is trading at around 72.30, right in the lower middle part of the range. So without real strength of oil price, analysts are not expecting expanded margins on these major producers. And you can see the share price of ConocoPhillips greatly mirrors what oil has been doing. That said, like I said, scores of 48. The company's got really strong fundamentals in the sense that 1-year sales and earnings growth, while negative, 3-year sales and earnings growth is huge. Profit margin of 19%. So that 1-year compression of margin is really hurting them. They're estimated to grow earnings 6.2% next year and sales 13.5% next year. But until you see significant upward price on the price of oil, I don't think this thing is going to be reporting rosy guidance. So I'm not expecting much from Conoco.
Now, we all love Amazon, and correct me if I'm wrong, I do think that we can expect good things from them.
Yeah, they at one time, just used to make money on AWS, their cloud computing. And but now they make money on everything. And a lot of their delivery is now being outsourced. So they got bean counters running Amazon now. Their sales are supposed to be up 10.2. Their earnings are supposed to be up 48.6. We got positive balance revisions, big surprises. Your mom owns it. I don't, I hold it for some clients, but it's not my portfolio models. But I do expect it to do very, very well.
Yeah, this is another stock I don't bet against. It's 75.9, right in the middle of our buy zone. What I look at, very strong technicals, solid fundamentals, could be a little better. Here's where it is for Amazon. It's about the margin growth now, the profit margin. You can't expect tremendous growth the way it had for nearly 2 decades, just growing those sales with negative earnings forever. Now, like you said, they're making money. They're making a 5% profit margin. So they're estimated to grow sales 21.7% next year and earnings around, let me reverse that. They're estimated to grow earnings 21.7% next year and sales 10.8%. So each incremental growth that they're seeing, if they can manage their margins, that's going to translate into bottom line growth. And that's where the real power of this company can be. It doesn't necessarily have to grow sales and earnings, but now that they're turning profitability in other divisions, that's a good forecast for future strength. So the growth I'd like to focus on is in the profit margin.
The other example of how Amazon squeezes people, UPS had horrible results, and they are actually going to deliver less Amazon products because I guess Amazon was squeezing them too hard. So
Wow.
It just shows how the bean counters are running Amazon right now.
And finally, what are your expectations for Fortinet?
Well, this company is a big service company to the cloud, and they provide firewalls, all kinds of good stuff. They are a bellwether. So we want to see what they say about the cloud and security, etc. Their sales are supposed to be up to 12.8. Earnings supposed to be up 19.1. The positive balance revisions, it looks like it's going to be a nice surprise. I do not own the stock at this time. I have owned it in the past.
Yeah, Fortinet is synonymous with cybersecurity in this day and age where people are getting ripped off left and right and there are scams all over the place. Their products and services are in high demand. This thing is one that I have not bet against in the past. It's 79.3. It's got that golden score for me, really strong fundamentals, 75%. If anything, the technicals are a little overheated. So if they meet expectations and they don't issue stronger guidance, I would expect the share prices to trade down. However, this thing has a strong history of beating and guiding higher and a massive growth engine. So we're talking 1 year sales growth at 20%, earnings growth is 36%. The 3 year is similar, higher double digits. It makes a nasty profit margin of 22%. They have tons of free cash flow, and they're slated to grow earnings next year 8.1% and sales 12.4%. I mean, the shares have risen 326% in 5 years, and they do that on these historic beats. They gap up, they gap up, they gap up. They've seen a lot of institutional money flows. They don't pay a dividend yet, so they're still in very strong growth mode. I really like this setup for this company, but it is predicated on keeping that rosy guidance and keeping optimism, because if they just meet, which might be phenomenal numbers, and they don't guide higher, I think we would see pressure on the share price.
Now let's switch over to subscriber questions. One of our subscribers wanted to know what your thoughts are on SMCI.
I'm still comfortable with SMCI because their forecasted sales are 180.4%. and earnings are forecast to be 119.6. I know they have a new auditor. The analysts are still revising their estimates higher. And so I'm going to wait for the earnings to go dramatically higher. You know, we do have a friend in the AI business, chip business. He says that Supermicro makes the best rack system, best servers by far. Dell and HP have not been able to really capture market share. So I'm sticking with the stock. Obviously, I bought it a long time ago, well before anybody knew about it. I still have huge capital gains. I don't want to realize, but I do want those good earnings to come out and drop kick and drive that stock higher. And of course, they have a new auditor, so they're going to announce a couple quarters, I believe, when they announce.
Yeah, this is a stock that I hold in a publishing portfolio. You know, we doubled, then tripled our money, took 2/3 off the table. I hold the rest for free. But I'm with you, Louis. I mean, the stock score is a 50, right in the middle. Technically, it's a 32. Fundamentally, it's a 75. So this is one of those instances where people beat it up because they thought the growth is unsustainable. And then, you know, the most recent pressure with AI affected the stock a couple of days ago, the DeepSeek thing. And like you said, they had the sort of accounting scandal and all that stuff. They have a new auditor. They fought off the short sellers report. The shares have been trading near lows. But you look under the hood and it's a totally different story. 110% one-year sales growth, 80% one-year earnings growth, 3-year sales growth, 64%, 3-year earnings growth, 117%, and they make a profit margin of 8%, which should be expanding because they're estimating sales to grow 21% next year and earnings to grow 23% next year. Stock's up 900% in 5 years, even though it's trading down significantly from highs of 118. It's trading near 28. I think there's a lot of runway. They make a great product. Their servers are optimized to be green, so more energy efficient, power efficient, so your savings on the powering cost. Nobody else really has that slant, and nobody's growing like them. So I think this is a case where they got humbled a little bit, and I'd be interested, for one, to see if growth is going to resume these or maintain these phenomenal digits.
Another one of our subscribers wanted to know what your thoughts are on PSN.
That's Parsons Group. Their sales and earnings look wonderful. Just so everybody knows, their sales is supposed to be up 17.6. Earnings supposed to be up 32.3. Analysts have revised their estimates from 84 cents to 91 cents in the last 90 days. Great earnings surprise history. A lock and load on Parsons. I'm not worried about it at all. Was impacted by the DeepSeek news because it does a lot of work with cloud computing and things like that. But they also provide a lot of services to the government. So I'm not worried about this stock one bit.
Yeah, this is another one where we overlap. I have this in a publishing portfolio. Right now it's scoring a 50, but it's the same story as SMCI. Technically, it's weak, beat up with DeepSeek, like you said. Fundamentally, it's one of the best out there, 79% scoring for me, and that's due to huge 1-year sales and earnings growth, very strong 3-year sales and earnings growth. It is making a profit margin, which should expand with these rosy 1-year estimates. So I'm really interested to see the 1-year earnings estimate. Right now it's 15.1%, and the 1-year sales estimate 8.8% growth. If we get any sort of beat in there and positive forward-looking statements, this share price has gone straight down from a high of 112 to where are we now, around $80. There's been a lot of pressure. And when I see a lot of pressure on a fundamentally superior stock and people get caught offsides on a really positive earnings call, I say a little prayer for the shorts is all I'm saying. I expect good things for Parsons.
And I would add that Parsons is provides the FAA with a lot of systems. Obviously, the FAA is under scrutiny due to the tragic crash in DC. But this is a huge government contractor, and they do cybersecurity, missile defense, intelligence, space and ground systems. Um, I just, I assume they have somebody sucking up to the Trump administration right now, because they have a lot of business with the government, and they're huge in the cloud. All those servers you see in Virginia on the way to Dulles Airport, they're in there operating a lot of those things.
Now, before we end, I think we need to talk about the Trump tariffs.
Yeah, I'm a little surprised. I thought Mexico and Canada were friends. I thought that I thought that they would do exactly what Trump wanted them to do, and then the tariffs would not show up. But I'm wrong. And so if this is how he treats our friends, God help all the other countries. Okay. So that means 100% tariffs on China could really happen. And we'll see how Europe sucks up to us as well. But Trump wants to replace the income tax system with tariffs. And that's what the government used to do before we had an income tax. And if he succeeds in doing this, he'll go down in history as a great president. But it's risky. Doing what he's doing is very risky, and it's creating a lot of uncertainty.
Yeah, so Trump tariffs, we've moved from being a producer nation in the 50s, 60s, 70s to a consumer nation almost exclusively. So setting up tariffs on items that come in or out, I always felt like this was Trump's bargaining chip. This was his posturing. He's pounding his chest, flexing his muscle. But it's almost like you said, the dog that caught the car, now what? He can't go back on it. So will be really interesting to say, because I always felt like these were threats to get people to do what he wanted. And we saw that with Colombia, right? He said, we're going to deport detainees. Colombia said no. He said, fine, here's a 25% tariff. Colombia said, never mind. We were just kidding. We'll do whatever you want. And we'll take an unlimited number of detainees. And I think that was the tact that he was going for with everyone. So it's really interesting to see because, like you said, it is risky. It has a lot of implications, but it's an interesting time. He is focused on America. You can't argue that.
Yeah, Canada grew at 1.8% in the fourth quarter. I think that's the annualized rate. They will be in a recession if these tariffs kick in. And he will basically tell them that move your manufacturing to America, and he's already told that to Europe. Volkswagen's responded positively. I'm a little surprised. Canada's biggest leverage is power. Manufacturing always goes where there's cheap electricity, and I guess they could put some tariffs on the hydro they sell us. So they got some direct current grids. He's putting the 25% tariff on Alberta oil, and there's no pipelines in Canada to go elsewhere. They have to send it through America. So this is getting to be very interesting. Now we go back to Mexico. We got leverage on them because they're buying U.S. gas to run their manufacturing. So this is going to be compound complex, but Canada will definitely go into recession if this hits, and I think he relishes telling the Canadian workers, you just move to America, I'll give you work permits. And I think that this is a wild card. It's a lot to make people move, It's and I'm sure GM and everybody's talking to him right now, and this is the biggest game of chicken I think I've ever seen. And I have no idea how it's going to turn out.
It is. It's also interesting when you factor in, how big tech places like Apple moved their headquarters to Ireland and tax safe places during a Democratic administration because you got to pay your fair share. And we see an example where the people who have the means, like large multi-billion-dollar corporations, just pick up and move. And Trump doesn't want that. He wants them all coming back. So let's not forget about that in the arsenal either. He can, he hasn't even talked about tax policy. He's trying tariffs first, see where that goes, and then talk about taxation to repatriate some of these companies and production in dollars here in the States. So I think he has a few things in his arsenal to try, but we know he's a ruthless negotiator and he's willing to get down and dirty, and that's what it looks like might be happening.
Yeah, so if I was Canada or Mexico, I would just be, I'd be having the biggest hissy fit right now. I mean, if they're not in DC on Saturday, I'll be shocked.
Well, I appreciate you both for answering all my questions and for all your insight. And thank you to you all for liking and subscribing and also commenting. We really appreciate all your comments. If you would like to ask any questions for the next video, please leave them in the comments below. But until then, we will see you all next week to discuss a new round of stocks for their earning announcement season. Thank you so much.